Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing world of corporate finance. And let me tell you, this latest filing is it is a story. This is Infinite Group Incorporated's quarterly report. And it reads less like a straightforward financial update and more like a cautionary tale wrapped in a series of evolving debt deals. Stick around because understanding what is really going on under the hood here could be a masterclass in how companies navigate serious financial tightropes. And hey, if you're into decoding these kinds of intricate financial stories, make sure you hit that subscribe button and join our Discord community, linked in the description below, where we break down more of these complex documents. So, Infinite Group Incorporated filing their quarterly report for the period ending the 30th of September 2023. Right off the bat, it is clear this company is facing significant challenges. They've filed these reports, but the checks here indicate they haven't filed all required reports over the preceding 12 months and have not submitted electronically every interactive data file. This immediately signals a company struggling with compliance and possibly operational stability. Let's dive into the numbers because that is where the real story is. As of the end of September 2023, Infinite Group had 521,175 shares of common stock outstanding. That number has gone up from December 2022, which suggests they've been issuing new stock. A common move when a company needs cash. The par value is a mere $0.01, meaning the actual value shareholders are putting in is likely much higher, and that is reflected in the additional paid-in capital. Looking at the balance sheet, total assets were about $1.5 million at the end of September 2023, a drop from roughly $1.6 million at the end of December 2022. Not a huge change in total assets, but how those assets are composed is telling. Their cash position is alarmingly low, sitting at just over $9,000. That is a sharp decrease from about $23,000 at the start of the year. When a company has less than $10,000 in the bank, it is always a red flag, suggesting they are running on fumes and heavily reliant on very short-term financing. Accounts receivable, which is money owed to the company by its customers, also saw a significant decrease from over $400,000 to just over $200,000. This could mean they're selling less, or perhaps they're having trouble collecting from their customers. They have an allowance for expected credit losses, which is a good sign that they are accounting for potential bad debt. But the low cash balance is still concerning. Now, let's look at the liabilities side. Total current liabilities jumped significantly from about $6.6 million at the end of 2022 to over $8.2 million by the end of September 2023. This is the money they owe that is due within a year. Accounts payable, what they owe to their suppliers, is around $1.6 million. But the concerning part is the massive increase in accrued interest payable, from about $780,000 to over $1.3 million. This means they are accumulating a lot of interest and likely struggling to make payments on their debt. And then there are the current maturities of long-term obligations, meaning the portions of their long-term debt that are coming due within the next year. This also shot up from a little over $500,000 to over $1 million for third parties, and from $385,000 to $659,000 for related parties. This means a large chunk of their debt is coming due very soon. They also owe over $1.8 million in notes payable, and another $219,000 to related parties. It is a lot of short-term debt for a company with so little cash. The stockholders' deficiency, which is essentially negative shareholder equity, grew from about $6.8 million to nearly $7.8 million. This means the company owes more than it owns, and the shareholders have effectively lost that entire amount. This is a classic sign of a company in financial distress. Now let's look at how they performed financially for the 3 months ended the 30th of September 2023. Their net loss was about $854,000. That is an improvement from the same period in the previous year when they lost over $1 million. For the 9 months ending the 30th of September 2023, the net loss was about $1.1 million. This is a huge improvement from the over $2.7 million loss in the same 9-month period in 2022. So on the surface, things seem to be getting better in terms of losses, but it is important to see why that is. Revenue for the 3 months ended the 30th of September 2023 was just over $1.7 million, virtually unchanged from the prior year. For the 9 months, revenue increased slightly to about $5.2 million from $5 million in 2022. So sales are sort of flat and slightly up, but the big story is below the revenue line. Cost of revenue, which is the direct cost of providing their services, actually decreased. For the 3 months, it went down by about 5.3%, and for the 9 months, it dropped by 8.4%. This is a good sign, suggesting they are becoming more efficient in delivering their services. This efficiency led to a better gross profit. For the 3-month period, gross profit increased nearly 8%, and for the 9-month period, it jumped a significant 24.6%. They are making more money from each dollar of sales. However, general and administrative expenses also increased by about 17% for the 3-month period, but for the 9-month period, they actually decreased by over 7%, which is good. The reduction of legal and accounting fees related to a past filing, the S-1 filing, helped here. Selling expenses are a mixed bag. They decreased by about 7% for the 3 months, but increased by about 7% for the 9 months. This increase in the longer period was due to higher marketing spending, which they expected. This all led to a smaller operating loss. For the 3 months, the operating loss improved by about $8,000, and for the 9 months, it improved by a significant $435,000. So, the core operations are looking a bit healthier, but the interest expenses are really eating them alive. Net interest expense for the 3 months ended the 30th of September 2023 was about $270,000, a decrease from nearly $500,000 in the prior year. However, for the 9 months, net interest expense increased a whopping 60.3% to $1.4 million from $900,000. This massive increase is due to bridge loans taken out and significant penalty interest on defaulted loans, and then to raise other income. For the 9 months of 2023, they reported over $1.7 million in other income, largely due to a tax refund related to the employee retention credit and some debt forgiveness. This one-time income significantly masked the operating activity's true financial picture, turning a much larger net loss into a smaller one for the 9-month period. So, while the net loss for the 9 months looks much better, that is largely thanks to this tax refund and debt forgiveness, not necessarily from organic business improvements. They are still losing money, but less of it, propped up by these extraordinary items. Looking at the cash flow statement for the 9 months ended the 30th of September 2023, the company generated about $423,000 in cash from operating activities. This is a positive turn from a negative $699,000 in the same period last year. This improvement is likely due to better management of working capital and the positive impact of those one-time income items. Investing activities show a positive $1.2 million. This is largely from selling an employee retention credit claim. They also continued to spend on software development, which is a necessary cost for their business. Financing activities show a significant outflow of about $1.6 million for the 9 months of 2023, compared to an inflow of about $772,000 in the prior year. This means they have been paying down debt or receiving less in new loans compared to last year. The company's liquidity situation is precarious. They have very little cash on hand, about $9,000. They rely heavily on a factoring line of credit, which is essentially selling their accounts receivable at a discount to get immediate cash. They had about $28,000 available on this line at the end of September. This is a common lifeline for companies in distress, but it comes at a cost and is not a sustainable, long-term solution. The subsequent events section is really where many of the recent financial activities are detailed, and it is a whirlwind. They have received funding from various loan agreements with entities like Stripe, Celtic Bank, Fresh Funding Solutions, UFS West LLC, Agile Lending LLC, and Harry Hoyen. Many of these are short-term, high-interest loans or agreements to sell future revenue at a discount. For example, a loan with Agile Lending LLC in March 2024 had an effective interest rate of approximately 170%. This indicates a desperate need for cash, forcing them to accept extremely unfavorable terms. Interestingly, on the 16th of August 2024, they entered into an agreement to borrow up to $2 million from Harry Hoyen. While the stated interest rate is 8%, the payment plan detailed suggests a much higher effective rate. This is a related party transaction, which can sometimes raise concerns about fairness and transparency. Multiple instances of forgiveness of debt are mentioned in the subsequent events. Lenders forgiving portions of loans can happen, but when it happens repeatedly, it often signals that the company is struggling significantly and the lenders are trying to salvage what they can or restructure to avoid a complete write-off. This also impacts their financial statements, sometimes showing up as a gain, which can artificially boost net income in periods where operational performance is weak. A major event was an intended sale of the ACE Server Management division, which was supposed to close in June 2025 for $7.5 million. However, on the 31st of July 2025, the agreement was terminated. This is a huge setback, as it was likely a key part of their plan to improve their financial situation. The cancellation of a major contract with Peraton also led to layoffs further indicating the company's struggles. In their management's discussion and analysis, they acknowledge the substantial doubt about the company's ability to continue as a going concern. This is the most critical statement in the entire filing. It means the auditors and management themselves are saying there is a real possibility the company won't be around in the next 12 months without significant changes or additional funding. Their business is cybersecurity, focusing on small to medium-sized businesses, offering software like Nodeware, consulting, and managed services. They aim to differentiate through a combination of software and professional services, and a strategy of acquiring other cybersecurity companies. However, the execution of this strategy seems to be hampered by their dire financial condition. If we look at the net loss per S-share for the 3 months ended September 2023, it was negative $1.65. For the 9 months, it was negative $2.30. While these numbers represent a smaller loss compared to the previous year, they are still substantial losses on a per-share basis. So, what is the overall picture here? Infinite Group Incorporated is in a very difficult financial spot. They've been surviving by taking on a lot of debt, often at very high interest rates, and through related party transactions, they've received a temporary boost from a tax credit and some debt forgiveness. But their core operations are not generating enough profit to cover their expenses and debt obligations. The termination of a major asset sale agreement is a significant blow, and the language about substantial doubt about their ability to continue as a going concern cannot be ignored. While they are trying to improve efficiency and grow revenue, their immediate liquidity crisis and heavy debt burden cast a very dark shadow over their future. It is a testament to how challenging it is for companies to navigate severe financial headwinds, and how crucial it is to watch for these signs in their financial reporting. What do you think about Infinite Group Incorporated's financial health and their strategy? Let us know in the comments below. If you found this analysis helpful, give this video a thumbs up and subscribe for more in-depth looks at corporate filings. And don't forget to join our Discord community in the description for more discussions and insights. Thanks for watching, and we'll see you in the next one.